The RBI's latest set of regulations mark one of its boldest liberalization pushes in years. Last week, in a single stroke, the central bank announced 22 deregulatory measures, the highest in a single day in its modern history. So, companies can now borrow up to $1 billion abroad without prior approval. Banks can finance acquisitions, which was earlier an absolute no-no. They can also fund larger IPO plays. In other moves, investors have been allowed to pledge more equity for credit. All this in a bid to deepen capital markets and spur investment. Even as the central bank kept policy rates unchanged, it has flung open multiple windows of credit and capital. It's a signal. The RBI may not be cutting rates, but it's cutting red tape. But as the guardrails come off, the questions come flowing. What's behind the hyper-liberal stance of the new RBI Gov Sanjay Malhotra? Why the change in stance? Isn't the RBI supposed to be a conservative guardian of public funds? Do these moves unleash fresh credit and capital or sow the seeds of new risk? What about inflation? And is this a gamble on global liquidity staying kind? I put these and more questions to ET's economics guru, its associate editor, Sugata Ghosh, in this episode. Listen on, it's Tuesday, the 7th of October. I'm Anirban Chowdhury. This is the Morning Brief. Hi, Sugata. Very warm welcome to the Morning Brief. Always a pleasure to have you.
Hi. We live in interesting times.
Absolutely. And a few things more interesting than the RBI announcements last week, a spate of deregulations. Let me start by asking you, what do you make of them, the expanse of the announcements, the timing, and the impact?
There's a clear consensus among the men who matter. It's very evident. There's a unanimity that deregulation is the need of the hour. Whether it's the right thing is a different debate. But the government, the regulatory agencies, and other decision makers, they're of the view that we should deregulate, give businesses a chance who have been complaining about rules, regulations, compliance burden, and red tapes to do their business. So that's the way forward. And when the relationship between the government and regulators is frictionless, it becomes easier to come out with a raft of measures. Now, why financial services measures? Financial sector measures are often the easiest to take. Say, unlike labor reforms or agri reforms, these take months, years. But financial sector measures, particularly measures which have been long pending, which are low-hanging fruits, it becomes far easier to execute them. So that's where they come from.
Right. Let's take some of the most important measures. For example, the nod for banks to finance corporate takeovers. This had been an absolute no-no for the last several years. What do you think made the central bank change its tack on this?
Well, banks have been asking for a long time. Corporates have been asking for a long time. And there's no reason why it shouldn't happen. For instance, the foreign branches of Indian banks, they can participate in acquisition financings. They can lend to corporates to take over a company. But the local branches can't. Foreign banks will find out some offshore structures to lend to corporates so that they can buy out. So there is no reason why Indian banks should not be a part of the game. Of course, the finer points, we don't know whether they will allow LBOs, to what extent they will allow LBOs. When you actually take over a company, betting on the cash flow of the target company, because you use the cash flow to repay the loans, right? Now, how aggressively this will play out is something we don't know, but it was long pending.
Right. And also the RBI has raised limits on lending against shares and IPO financing. What do you think of that?
Well, IPO financing is a safe avenue, right? I don't think banks lose money in IPO financing. So there is no reason why you shouldn't liberalize the norms. The 20 lakh limit has been there for 20 years. There is no reason why it should not be raised. Now, not all banks have the wherewithal to do this, because when you are lending against shares, you have to keep a margin. You have to keep a tab on the price of the stocks which are pledged. If the price falls, you ask for more margin to replenish the limit.
Right.
If the banks have the monitoring system, the wherewithal to do that, it's a lucrative business. Why not? And individuals beyond mutual funds, they have started investing in direct stocks.
Mm-hmm.
So people with the risk appetite, they would go ahead and do it. But not all banks have the expertise to do that. Even with 20 lakh, only a handful of banks, private banks, and some of the foreign banks who are aggressive in retail, they have been doing it. Most of the public sector banks, they don't do it. So even today, I don't know to what extent the banks will live up to it.
But with the whole spate of overvaluations in the market, not just in the IPO market, but also among listed companies, couldn't this lead to speculative bubbles, you think?
Not exactly. I mean, loan against shares by individuals will not fuel the speculative bubble.
Okay.
What will happen is that if the bubble bursts, then some of these people will take a hit. But then that's a conscious thing. If people are willing to pledge their stocks and bet on the stock market, I mean, they're making the investment with their eyes wide open. And it's there everywhere across the world.
Sugata, what do you think of the opening up of external commercial borrowings, the higher limits and other things?
I would say ECB is the most significant part of this entire dose of measures which RBI has taken. They have relaxed the ECB norms. As far as the draft policy is concerned, any non-resident, including non-resident Indians, they can lend.
Mm-hmm.
Say small outfits like limited liability partnerships. They can borrow from their NRI partners, pharma companies, technology companies, or creative enterprises can pledge their brand, trademark, intellectual properties to raise money. Because for these kind of companies, those intangible assets hold the real value of the companies. Now, if you can monetize those assets to get cheaper funds, so it adds to the flexibility. They've also indicated that ECBs would also be allowed in real estate. Even today, ECB foreign loans are allowed in real estate, but such loans are only for very large projects like SEZs, integrated townships. But now they are saying that if a project is eligible for foreign direct investment, it can also take foreign loans. Now, the entry barrier for foreign direct investment is quite low. The threshold is quite low. Even comparatively smaller projects can take FDI. So those projects can also tap the ECB market. Now, this is a tricky area in the sense that RBI has been resisting it for a very long time because past governors of RBI, for many of whom the Asian crisis was very much in their mind, where countries like Thailand, Malaysia, Indonesia, South Korea, they took large foreign loans, their developers, and did huge real estate projects.
Yeah.
That fueled the bubble. And when the bubble burst, the devaluation of those currencies happened. And when the devaluation happened, the debt in their local currencies were huge and unsustainable. Right? Now, I'm not saying it's a story that will play out in India. Real estate as a sector has evolved. It has become more corporatized, right? You have products like REITs. You have regulations like RERA.
Right.
And remember one thing, that large corporates have entered the real estate sector. So that changes the scale of the industry significantly.
Do you think the deregulation in ECBs has largely to do with the pressures in the forex market?
Absolutely. I would say that is the prime reason. We need dollar supply. RBI just can't go on intervening. FPIs are selling. There is a pressure on exports. And our imports can't come down dramatically, right? Even if oil softens, there would be some ease on the current account deficit. But going forward in the medium term, foreign exchange reserves will have to be tapped to intervene. Now, RBI can't go on indefinitely doing it. We must find a way to bring in dollars. Now, how do you bring in dollars? A country can do sovereign bonds. A country can do quasi-sovereign bonds, as we have done before through SBI. Or a country can attract FDI. FDI takes a long time. It's not in your hands. As far as sovereign bonds are concerned, well, the dollar will come and then what, right? ECBs are possibly the simplest way to increase supply. Even though it's a debt, there is an inflow of dollars. When dollar supply increases, it supports the rupee. So that I would say is at the top of their mind, because as you have seen that rupee has been weakening and RBI has been intervening. It is also letting the rupee weaken a little to help exporters. That is the widely shared perception. But it just can't let the rupee drop, right? Because the tariffs are so high that you'd need an enormous devaluation to match that. So that is not a realistic or a practical step. So at the same time, you have to increase the supply of dollars. How do you do that? So ECB is possibly the quickest and the easiest way to do that.
Right. Now, you spoke about predecessors, and Sanjay Malhotra, who's the current RBI governor, is trying to be seen as a liberal RBI chief, as much as his predecessor, Shaktikanta Das, was conservative. Do you think he's signaling a shift in regulatory philosophy? And does this worry you at any levels in terms of risks? I mean, after all, RBI is seen as a conservative guardian of public funds.
It's a little early to say, but going purely by the measures, for instance, NBFCs have been given a very long rope when it comes to ECBs. They can almost borrow any amount they want. Now, their balance sheet is largely in rupees, but the foreign loans would be in foreign currency. So that currency mismatch is there. They've been given that choice. Some of the measures, I would say, are slightly surprising. I didn't expect it from RBI. But Malhotra is not an economist. He joined as the governor. He didn't work in RBI before. He doesn't carry the baggage of an economist. He is not bound by the thinking within RBI. I won't be surprised if many people within RBI have some reservations about the deregulation. But then the unanimity between RBI now and New Delhi, I mean, they're both on the same page. So some of these measures are surprising. At the same time, if you think deeper, these are expected.
Right. Do you think these deregulations square with RBI's usual inflation first mandate?
Well, we have a monetary policy framework, right, where we target the inflation. Now, that is a part of the law. You can't dramatically change that unless you change the regulations and the monetary policy framework. Traditionally, before the framework came in, RBI used to target multiple goals: growth, employment, money supply. But now there is a greater and greater focus on inflation. Now, there has been debate whether that is the right thing to do for an economy like India, where growth is of paramount importance. But I guess even if their stated posture is inflation targeting or inflation, I don't think RBI, particularly under the current circumstances, can take their eyes off growth. Growth matters a lot now, particularly at a time like this, where you have geopolitical tensions, you have this punishing tariffs, the multilateralism has broken down, we are entering into bilateral deals with different countries. It's a very different world we are entering into. And navigating that world would require keeping your eyes on multiple goals.
Right. And finally, Sugata, do you think our banking system is ready to manage these new risks?
That is a very, very pertinent point, because if you see the deregulation, a lot of responsibilities have been given to the bank managements and the bank boards.
Right.
Now, that is where there is a lurking worry. Because as far as managements are concerned and boards are concerned, their performance has not exactly been stellar.
Yeah.
At the same time, you're giving them a lot of responsibility. So the SOPs within the banks would be very important. For instance, in the export-import portal, a lot of small exporters, importers, they had a constant complaint that their payments, they're not being updated and their further business is being hindered because of lack of this updating. Now, RBI has said that if it is less than 10 lakhs, they can just write it off and go ahead.
Right.
Now, the point is that I'm sure 90% of the exporters, importers are genuine. They really do have a problem. But there would also be people who would try to write off by just simply sending money or not receiving money or doing some round-tripping transactions. So the banks will have to be a little cautious if they find that an exporter has not been receiving money twice, thrice, if it is happening repeatedly, then they should be in a position to question them. They can't just shut their eyes and write off. So those SOPs, those codes will have to be put in place by banks, organizations like FedI. These are important, particularly when you give the intermediaries, the service providers, a lot of responsibility to monitor.
Understood. Right. Sugata, thank you so much for joining us.
Thanks, Anirban.
Well, this seems to be the RBI's new playbook. Regulate less, supervise smarter, and let credit flow. As India opens its financial gates wider, the real test will be in discipline. Whether the balance between reform and restraint holds or tips into risk will decide how this chapter in India's financial liberalization is remembered. That's it for today. You were listening to this episode on The Morning Brief. It was produced by me and Vinay Joshi, sound designed by Indranil Bhattacharjee. A new episode of TMB drops every Tuesday, Thursday, and Friday on a listening platform of your choice. Also, don't miss our new show, Corner Office Conversation, where we talk to the most interesting business leaders in India and the world every alternate Monday, wherever you get your podcasts. Keep listening.